Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist. Taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Everyone, you're going to love this week's Facts versus Feelings. We are joined by Barry Gilbert on our team. We're just doing a brief intro. Sonu, we did record this before July 4th. What are you doing for July 4th?
I'm going to the beach.
There you go.
Chicago actually has beach.
Work on that tan, are you?
Yes, exactly. That's all I need, another tan. No, I got to be at the beach. It's funny, every time we go to the beach, by the time we're done, I'm so tired. And the kids just bring a ton of sand back into the car. So it's, I'm bracing myself all of that. But while you're at the beach, it's kind of nice. What about you?
That sounds good. We lived in Charlotte for a long time, so we're going to go down there. We always stay with our friends down there for the weeks. That should be fun. We're going to do a real quick crash course, though, on July. You're going to hear a lot about this, everybody. We'll share the chart on the YouTube channel right now. July, Sonu's been higher for the S&P 500. You ready for this? 10 years in a row. But the last 10 years, it's actually not the best month. Now, that's a trivia stat for somebody around July 4th. November, on average, is a little bit better. But this, if we're higher in July, that'd be 11 in a row. That tie the longest win streak ever in July. Also know this, July is the best month in a post-election year, the best month the last 20 years, second best month the last 10 years. So we have some momentum. And when you're higher in May, like we were up over 5-6%, and June, like we're going to be, July does a little bit better, but here's what I want everyone to know. The last 6 months of the year have been higher when those two normally weak months are higher. The last 6 months have been higher. 15 out of the last 16 times, up like 9 or 10% on average, almost double the at any time returns. There's lots of other stats, lots of other figures. I just think it's important to note this surprise summer rally will probably continue in July. We'll see, but I think it can. But the second half of the year still looks really, really positive. But with all of that, you're going to love this one with Barry Gilbert, portfolio manager on the team. We got really into the weeds of how we manage money, how we think about managing money, and how we work with our amazing Carson partners and their clients. With all that, here's episode 142. Have a happy and safe July 4th. I want to see everybody's fingers next week. Don't lose a finger shooting off fireworks. We'll see everybody next week. Enjoy this one. Happy July 4th. Hello, everyone. We've made it through the first half of the year. Welcome back to Facts versus Feelings. Ryan and Sonu, episode 142 of Facts versus Feelings, talking with the best portfolio manager we know, none other than our good friend and colleague, Barry Gilbert. Barry, give us your title. And are you really the best portfolio manager? I joked you're the only one I know. That's why I can say this. I don't know.
Title is VP, Asset Allocation Strategist here at Carson. And portfolio management's too hard. Call anyone the best portfolio manager that anyone knows. This is what I do know. I do know that you're only as good a portfolio manager as the people that you're working with and the relationships that you have with them and how you figure out problems together. And the most important thing that we talk about is if you're just averaging everybody's view, you're going to end up with a market. Put enough people in the room, even very smart people, and you average all their views, you end up with a market. And it's really about working with people who can critically think through what's going on and work together, have constructive debate, argument, discussion, and arrive at a genuine view. And I think that that's something that you get here at Carson that you don't get at other places. We actually have an opinion. We're not an economist who has too many hands on the one hand, on the other hand. Yes. We're managing real money. We have to get someplace. And with that, we're all only as good as the people we get to be around.
No, that's great. I honestly mean, I've talked to several portfolio managers, hundreds, over the course of doing due diligence for different funds and products and things like that over my lifetime. But yeah, I think Barry's right up there. I think Barry's one of the best, if not the best. So, but to your point, maybe that's a good place to start off with. Like all of us manage the portfolios together. I mean, we've got our big picture views. Ryan talks about it all the time. I look at the economy. I'm talking about that all the time. But it's, one thing to have all that. It's a whole other thing to convert it into portfolios, decisions, right? Like how much should, what percentage U.S. equities do we want? And how much should it be overweight or underweight and things like that. But we, one thing is we don't do this by committee, right? Like Ryan votes, I vote, you vote, and we have grants too. And like, oh yeah, okay, the vote is 3-1, so let's go ahead with it, right? I feel like everything we do is kind of unanimous, right?
We hunt for the answer, and while we're doing that, it's not just about driving to consensus. That sounds like you're just forcing everyone to agree. We really hunt for the answer, and we work at it together. We look at the numbers. We all come in with different perspectives, but we all, I think, share a view on the big picture and how we should be doing things. And I think that helps us get to the best answer and not just a vote or an average view or something like that.
Yeah, I was thinking, Sonu and I do this weekly podcast, and we have so many people listen to it, and we point out we manage real money, right? There are so many other financial podcasts you can listen to, really, really good ones. They're not managing money also. And few things, Barry, I think are harder than having a big macro view. And I think stocks are going to do this or stocks are going to do that, but then transforming it into models, into real money that clients use, that advisors use, and being right. Like an example is 2023. You could have been a big bull in 2023, but if you didn't have some tech exposure, it really wasn't a good year. You want to build on that, how hard that is to take, I guess, like house views, Carson house views, how we see the world, but making it into a model and making sure it does what it's supposed to do. That's why I said I've worked with financial advisors a long time. I've worked in the retail or the research world a long time. You and I worked together in a past life, and one of the very first people that when Bert White and I were talking about who do we want on our Carson Investor Research team to help us, kind of some gaps we had to be honest, it was you, because you're one of the very best people at taking a big macro view, but making sure it's in the models and making sure it does what it's supposed to do. Because everybody, if you've managed money, that's not nearly as easy as it sounds. Barry, I don't even know what my question is. I'm just talking. Go ahead. So maybe ask them a real question. Yeah.
Maybe to start off on that is you always say you need a good foundation.
Yeah.
Right? What is your neutral? If we didn't want to make any bet at all, if everything is uncertain, now we obviously have our views. We've had our strong views over the last couple of years. This year, I feel like our views have sort of softened a little bit. We're still optimistic and all that, but it's softened. Going back to even before tariffs and Liberation Day, Ryan had talked about the fact that the third year of a bull market wasn't all that strong as the first and second year. Just based on nothing else, that would be like, let's temper things, right? Mm-hmm. But what does that mean when you temper our views? Where do we land up?
Yeah, it's we are not afraid to take big swings when we think that the opportunities are there. And we'll shorten up on our swings and try to hit singles and doubles when the opportunities aren't as strong. There are always opportunities out there. And also singles and doubles when there's a lot of uncertainty. And we continue to have our most basic conviction has been to be overweight equities. That did not feel so good at some points in the year. I think Ryan got yelled at an awful lot every time he went on TV. Yeah. People raised their eyebrows at him and what are you thinking and what are you talking about? I'm sure you're enjoying going back on those same shows now and saying, okay, here's what I was thinking and talking about.
So I'm literally in a couple hours on with our good friends BNN. That's the Canadian Bloomberg. Anyway, I was thinking, we're hitting new highs. Hopefully the day we're doing this. We are recording this, by the way, everyone, on Friday the 27th, doing a little early with the holiday. I said, wouldn't it be funny if I was on Canadian TV and lit off some fireworks for July 4th and new highs? I don't think I'm allowed to do that, but no, anyway.
Especially for our friends in Canada, right now.
They're our buddies. No, I love being in. It's a great show. I'm not going to do that. But yes, Barry, to answer it, we took a lot of arrows, a lot of body shots, really for a couple of years, but specifically back in April.
Yeah, and for us, we start off by just saying, look, let's not try to out clever ourselves. You get a return from stocks. You get a return from bonds. Let's set a baseline where we're just going to take advantage of that before we think about everything else. I mean, people put things in the wrong order sometimes. They try to do the fancy stuff first, and then as an afterthought, they think, all right, well, what are the basics? And there's a very important order that you go in. Get the basics down. None of us are as smart as we think that we are. And fortunately for a lot of stuff in investing, you don't have to be. Right, you can just take care of the long-term returns, the risk premium that you get from stocks and the risk premium that you get from bonds, and then do the other stuff on top of that. And I think one of the biggest mistakes that people make all the time is that they forget about that. So we start out very strong emphasis, keeping it simple. It's something that in a way anyone can do, but at the same time, it's really hard to do, because a lot of times we're our own worst enemies. And then there's all kinds of stuff that you can do on top of that, and you can think about it. But while you're doing all that, you can't let go of the foundation. You can't lose the foundation. And so we've got that solid starting point. That's always where we're going to begin. And then we figure out what can we do to add value on top of that without taking away from ourselves the basic returns you get from investing.
I like to think of that. Our base case is what could go right. Right. I love Ryan's chart of like the Dow Jones with all those different things that happened over the last 100 years. And maybe we can, Josh, you can put that up. We'll find it for you. I'm sure Ryan.
Yeah, I call it the chart of worries. So on the YouTube channel, Josh, mark the time down, but we'll share the chart of worries right now.
Right. So that's your base case. To your point, the foundation is that stocks have, it should be what could go right. That's our base case, right? And then everything else is, around that, especially from my view, like Global Macro Strategist, official title. My job is to figure out what can go wrong, right? But then, that should come later, I feel like, to your point, as opposed to, and your base case should be what could go right, what has gone right over the last 100 years.
Yeah, and what can go right? In some broad sense, capitalism can go right, which is just freeing up human behavior. People choose to work, generally speaking, rather than not work. People look for better jobs. They look to innovate. They look to improve. They look to grow. They look to grow their companies. They look to find better ways of doing things. Everybody in a small way is doing that all of the time. That's the most fundamental what can go right. I'm kind of an optimist on human behavior. And those decisions, that's ultimately what pushes markets up higher. That's ultimately what makes it possible to people pay things off when they borrow. So obviously things can go wrong sometimes, but thinking about what can go right and kind of the system that we're in that encourages us to try to improve things, that's a big going right. And that's an important thing not to forget.
We had Sam Rowe on the podcast 2 weeks ago, going with the flow with Sam Rowe. And we went on some tangents with Sam that were really neat. Barry, I want to deal with you. We'll get back to models, portfolios, the world, but your career is very unique, given you're now, yes, a portfolio manager, working with advisors every single day, managing billions of dollars. But go walk us through your career. It wasn't the normal one. I guess we'll go there.
I feel like none of us has been like have had a normal trajectory to this, especially you, Barry. Yeah, talk about that.
I have my PhD in philosophy. I did teach philosophy for a while. I taught writing for a while, and in some ways it was a big change. In some ways, I feel like it helped me to prepare for what I'm doing now, because it just taught me to think in a way that simply didn't go with the norms, think through things for myself, go back to basic foundations. And I feel like all three of us were iconoclasts to a bit. Ryan, you got your start in your own particular way. It led you to not simply do what everybody else is doing. Sonu, you have your PhD in engineering. You don't approach things the way that everybody else does.
I'm like, you're the actual only true PhD, because all PhD are doctors of philosophy, right?
Doctor of philosophy and philosophy.
Mine is like mechanical engineering.
I'm the only non-doctor on apparently Facts versus Feelings this week, but
I'll
I've Dr. Pepper before, if that counts. I don't know. Yeah.
Yeah. So
I was looking at, we were joking around about what was lifting up our computers and the books that we had underneath our computers. And I was looking at what I had under mine, and it was an old guide to chess openings, and then Harold Bloom's Genius about different authors over history. And I thought that's a pretty good way to sum up my career. And the philosophy gives me the kind of big picture, humanistic, politics, human behavior side of it. But I love the analytics side too.
And again, you didn't see this was coming. We're trying to make this easy for a podcast, but I think I'm going to ask you your favorite quote or quote you live by. And I'm going to give you time to think about it, because I think the one I've used a lot, right? History doesn't repeat itself. It often rhymes. Mark Twain. I love that one. I mean, Barry is a scholar, a lot of things. Is there like a quote or maybe a person that you've looked up to over the years besides Sonu and I? You can't use Sonu and I. We know that. But is there a quote that maybe I've never heard of that you know that's a good one? I love quotes. By the way.
I do Einstein a lot, which is
Okay.
Einstein, pretty bright guy.
Yeah.
He said, keep things as simple as possible, but no simpler.
There you go.
And that's what I try to go by.
Yeah.
That's how I try to think of
I'm trying to think
portfolio
of what
management.
I would, and actually on my PhD dissertation, right in front, it's attributed to Socrates. I don't know if he actually said. Who knows what he actually said? But wise is he who knows he does not know.
Yeah, that's definitely Socrates.
Right,
Yep.
and that gets to getting back to portfolios. We want, like, the base case is what could go right.
Mm-hmm.
And then we are overlaying on, in 2023, one of the biggest bets we made, actually, yes, we were bullish, but a big bet we made was that, we didn't want duration.
Yeah.
Right? We were extremely short on duration. And anyone listening to this, duration is basically interest rate risk, right? We don't want to take on interest rate risk. And if you just went and bought aggregate bonds, you have 6-year duration risk, which means if interest rates go up 1%, the bond portfolio goes down 6% and vice versa, right? And our duration was like 2.5 years or something like that. It was way below. And then 2024, obviously, we were really bullish. You heard Ryan talk about that. I've talked about that. You implemented that in the portfolios, Barry. And then you came into this year also bullish, but connecting this to, what we're talking about, quotes and things like that. If we're not going to be right all the time. So how do you ensure that if we are wrong, it doesn't blow things up? It doesn't blow up the portfolio, simply said.
One is starting out with your neutral portfolio, but another one is diversifying your diversifiers. Looking for different ways to diversify a portfolio that can meet different kinds of environments. Now, you don't want all those to just cancel out, because then you're back at your neutral portfolio again. But I think there are smart ways to diversify your diversifiers. You can look at different kinds of asset classes that people don't normally invest in. You can look at different styles of investing that can provide diversification. So a couple of quick examples from our portfolios. We use low volatility stocks quite extensively. They don't keep up in an up market. They're not designed to. Over time, maybe they might even underperform by a little bit, but they'll help manage risk a lot in the overall portfolio. It's not the other thing that we do. We'll shorten up duration, like you talked about at times. We have commodity exposure in our tactical portfolios. We have gold exposure, and this is not somebody's just coming lately to gold. I think that we put that into our portfolios in 2023, thinking about just diversifying our diversifiers. We were in an environment where we didn't know if gold would provide good diversification.
It's gone up, what, 50%, 60%?
It's
again,
been
there's not a recommendation, by the way.
Yeah, it's done a lot better than we imagined. But even though it's done a lot better than we imagined, except for Ryan, I think Ryan had a better sense of gold's potential. But even though it's done a lot better, the reason that it's gone up is the reason that we put it into the portfolio. So if you can think about those different kinds of diversifiers to help you out in different kinds of environments, especially when the environment is uncertain, and the environment feels pretty uncertain right now. Could go in a lot of different directions. There's a fair amount of policy uncertainty. We're still bullish. We still think that the baseline for the environment is fairly positive, but we know uncertainty is higher. We saw that in the first half of the year. So, yeah, good ways to diversify the diversifiers. And Ryan, you've had great ideas on that, because I think you were one of the drivers behind gold. Sonu likes gold as well.
I'm originally from India, so I have to like gold. So
yes,
anytime I say anything about gold, you should take it with heaps of salt. Right?
Yes.
But the other interesting thing that we did when we put in gold, we also lowered broad commodity exposure. Right. Yeah. So we weren't necessarily looking for every kind of diversification, even within the commodity buckets. And there are different ways that we get exposure to commodities. Gold was a distinct preference. So it wasn't just kind of throwing everything in there and come up with really thinking about what the environment could be and what could work in those different kinds of environments.
So what I think I'm really proud of, a lot of different things, right? This year we came into, obviously we were one of the few places, as listeners know, bullish in 23 and bullish in 24. We still were bullish in 25, obviously. Remember looking around start of this year thinking, a lot of these bears that were kind of making fun of us, all of a sudden turned bullish. So I said, I bet that tree trees are going to get shaken pretty good. That happened in a big way. And everybody cut their targets. Everybody got all bearish. We never did. And now here we are back to new all-time highs, before the middle of the year that took place. Barry, how did our portfolios start the year? And how are they now? Because again, I love more quotes. The Lou Holtz quote, life is, I'll make sure I say it correctly. Life is 10% what happens to us, but 90% how we respond to it. Because just because we came into the year bullish, that doesn't mean, U.S. did great. There's a lot of other areas that did really well. How did we kind of massage our portfolios as the year moved on?
Maybe talk about the strategic and tactical. Strategic gets back to our strategic portfolio is based on like what could go right long term. We're going to be overweight equities, right, Barry? I mean, we'd have to see some major shifts on the horizon, which we don't, I should say, right now, for us to shift that. But the tactical portfolio is mostly what we're talking about, right?
Yeah. Strategic, we never changed our equity weight. We remained overweight equities. We did take down some of our equity overweight, but we refused to do it. I remember the explicit conversation when we were down 15%, 16%. What did we get to? 19? Is that 19? How far we went? We just said that's when we were having conversations about adding. But we did talk about if we reached a certain point, we wanted to stay overweight equities, but we'd take off a little bit of the risk. Something that we started towards the end of last year was initially we thought the environment would be very pro-cyclical, but there were things going on, especially with interest rates staying high, which we thought would persist, that we thought was worse for small and mid caps. So when it was simply a story of a pro-cyclical environment, we were looking at being overweight small and mid caps. And as it looked increasingly like rates would be higher for longer, we started getting pretty aggressive on lowering our weight. And our weight to small and mid caps pretty low at this point. We still think it's a pro-cyclical environment, just not a pro-cyclical environment that's good for small and mid caps.
On that point, I want to come back to, again, what happened this year, but on that point, small and mid cap, every time you go to Ryan's Twitter feed, you get some guy, I'm guessing it's a guy, that is like, oh, Ryan, you said you're overweight small and mid caps last 2 years, you're wrong. And yes, they underperform, but this gets back to what we were talking about. They underperform, but we didn't take a big bet there, right, Barry?
No, it was a fairly small bet. The actual big bet that we have right now is being underweight, small and mid cap. Much bigger than the overweight that we ever took. Some things we went in the opposite direction. We were, I would say, not extremely, but we were solidly underweight international compared to what our benchmarks are. And there are actually macroeconomic things happening. And Sonu, you're the lead on that. Kinds of stimulus, and you can talk about it, that could potentially take place in Europe, Germany in particular. And we decided at that point to go neutral on international. Now, we and a lot of other folks have been underweight international, no matter what you think of as your neutral or your benchmark. But I think that we moved probably more aggressively than most, just getting back to neutral, saying that the clarity of the U.S. continuing to outperform global stocks had decreased quite a lot. And so we just didn't want to take a bet one way or the other relative to our benchmarks.
And what's a neutral level, Barry, on that U.S. versus international stocks?
So neutral for us is 30% international and 70% U.S. Now, there's no law for what your neutral is. Sure. I know people who, a lot of people are at 20. A lot of people use the ACWI, the main global index, and I'm not even sure where that is. International's been doing better.
I think it's like 66 or 67% US, 33, 34%.
Yeah, and it might have even crept up a little bit from there over time. So, that's neutral for us, and we think of ourselves as relative to that neutral, and we moved back to that point, and right now we're pretty happy that we did. Another form of diversification, if you think about it.
Yeah. So out of that 30%, I want to talk about that for a second. So there's developed international. Think, I guess, Europe, Australia, Japan, kind of maybe South Korea, I believe. And then there's the emerging, Canada. Then there's emerging markets, EM as well. How do we see that 30, Barry? What are we doing in our portfolios?
Well, I'll leave that to our macro guy, because Sonu, I think it's really your analysis that's driving a lot of that view.
Yeah, generally, the 30, if you think about it, let's say very simply, maybe something like 20%
Okay.
developed markets, 10% emerging. We are underweight emerging. We've been underweight emerging for a very, very, very long time
Yeah.
because of what's happening in China. China's slowing and things like that. But previously, we were underweight emerging. We were also up in 2023, 24, especially underweight international altogether. It was pedal to the metal, overweight equities, overweight US equities, right? So, which is why, and when we say US equity overweight, it's mostly large caps, even though we had a small overweight to mid and small. And when you're overweight large caps, which sector are you mostly exposed to? Tech.
Yeah.
So
right.
despite being we were just neutral on tech, but tech drove returns. And so we got the benefit of that. That gets to Barry's point of what could go right, right? Just our base portfolio, we want that to go right, and minimize the impact of anything we get wrong. But yeah, coming into, as we moved in before Liberation Day, we got to, I think, our neutral international overweight, but we had overweight developed markets, especially Europe, and underweight EM, right? And EM mostly is China, so we essentially underweight China.
Yeah, I'll jump in just for a second. Live in Cincinnati, Ohio. Just had lunch or had some ice cream the other day with Todd Stone.
I saw the milkshake.
Yeah, with Todd Stone. Shout out to Todd over Strategist. Great guy who's in town for some client events and stuff. And I said, well, I don't really want to go to your client events. I don't need to do that. Let's just you and me hang out. So at the end of the day, we had ice cream. Barry, I want to ask you this because Todd's a bright guy, big fan of Strategist. I know you are too. He said, maybe it's time for Japan. So Europe's done amazing. We've liked Europe a lot. It's done great. He's talking about Japan. And it got me thinking a little bit. Todd's talking about Japan. I know they've been talking about Japan for a while, Strategist. So do you think Japan maybe takes the baton a little bit from Europe, maybe the second half of the year because Europe's done so well? Or how do you see developed international?
I think the stimulus that's coming out of Germany that we had mentioned, because they're just really changing the structure of what they can do and can't do. It's just starting.
And they want to boost defense spending. Trump was just there in Europe saying NATO
all of Europe, all of NATO
defense spending.
Boosting defense spending. Yeah. I think there are a lot of interesting things going on in Japan as well. I think the unlocking shareholder value, I think, has become more of a focus in what they do. That's helped them to run better businesses. But Japan is obviously very exposed to how China does.
Yeah.
And so if you have some skepticism about what's going to happen in China, at least on the margins, you should have some concern about what kind of impact that might have on Japan's economy. Okay.
And I guess bottom line, sorry, so I'll jump in. Yeah, no. It's a global bull market. We've been talking about this. I mean, most of these countries we're talking about are all-time highs, 52-week highs. U.S. is obviously caught up. I think, we're going to give away. Oh, by the way, spoiler alert. Next week on the Facts versus Feelings podcast is our mid-year outlook. So that'll be Sonu and I talking about how we see the rest of the world. I always say world. I don't know why I say this. This is not the first time I've said this. The rest of the world, the rest of the year playing out. If you listen to this podcast, you probably have a clue where we're going to be. We thought it'd be awesome to have Barry come on and talk about kind of the first half of the year, how we got here. And then next week will be part 2, kind of where we're going. But maybe go that route, Barry. I mean, it's a global bull market. And maybe you don't like China that much. China's up a lot. I mean, every stock market now is pretty much up. It was U.S. and India. And was it Taiwan was the other one? Or in the U.S. India?
Taiwan, yes.
Yeah, those three
Taiwan and India were lagging, and U.S.
They lag, but my goodness, U.S. is doing awesome the last 2 months. So maybe I think it probably continues. I think U.S. probably plays catch up to a degree. Talk to me about global bull markets, Barry. I mean, how cool is this? From a portfolio point of view, how cool is this?
Connect that to diversifies.
I mean,
Japanese equities.
I love when we have a global bull market. It makes it even easier to be part of a rising tide. A rising tide lifts all ships. That's
there you go. Another one.
You got a global market that could work out. MSCI All Country World Index, ex-US, so that basically is rest of the world. As of yesterday's close, up 17% and change.
Wow.
Now, the U.S. isn't bad. The U.S. S&P 500 up 5.1% as of yesterday's close, total return. Yeah, I think about that, and I think about what we've gone through in the first half of the year. And if you just looked at that endpoint number and said, okay, that's the only thing that you knew about the year, and you'd feel like, hey, that worked out exactly aligned with everybody's forecast. Except, Ryan, you shared some charts on X about this. Where did everybody's forecast go? It was pretty bullish, and everybody's forecast plummeted, and now it seems to be halfway back to where we were before. Well, what did we do? How much did we move around our forecasts?
We didn't. Now, one could argue we had a 10% drop in 2 days. We didn't have time to do it, so I'm not disagreeing there. But the reality is, no, we've left our forecast between 12 and 15% total return on the S&P 500 all year. When we were down 15% for the year on April 8th, trust me, we were looking around like, oh boy, that's a long way away. Now, we're not going to give away our forecast for the rest of the year, but we'll do that next week. But the reality is, no, we hung tough because we continue to think that a lot of the things were happening, as we talked on this very podcast, were a tad extreme, and extreme on the way down could be extreme on the way up. That's why we just had literally one of the greatest 2-month rallies in the history of the stock market, up 20.1%, 2 months off of the April 8th lows. And as I mentioned on this podcast before, when you have a 20% rally in 2 months, you're talking off the lows in 74, off the lows in 82, off the lows in 2009, and off the lows of COVID, March of 2020. 1 year after that 20% bounce in 2 months, the S&P was up over 30% on average. We are not calling for a 30% rally over the next approximate year. Not going to complain, but that's another beach ball under the water. Let it go. Once it gets going, it can keep going if that economy stays strong, and that's the big caveat. I get it, but that's another reason I think we do remain overweight equities and thinking the U.S., my personal opinion, U.S. probably plays catch up the rest of this year and leads to a degree, which will be a good thing. What else we want to talk about, guys? We've got maybe 15 minute warning. 15-minute warning.
30% returns. Any guesses on which country, even two countries, have 30% returns this year? I'm looking at MSCI indices. So you guys want to guess? Any guesses? Which two countries? Think of like major countries.
I do a guess.
I'm going to take an absolute wild. I'm not sure exactly why I'm saying this. I'm going to take a wild guess because it would be one of the most unexpected, and say possibly Israel.
Israel, yes, but yes, Israel.
Poland's in there, right? In Poland, Greece.
Yeah, I was thinking like Israel and Poland, like in terms of market cap, they're smaller too, but Israel. Yeah. But something really unexpected, Mexico.
Oh,
remember? I think about like tariffs and all of this stuff, right? And Mexico's up as of yesterday. This is as of the 26th of June. We're recording this on the 27th. The MSCI Mexico index is up 30.9%, 31%. But that's in US dollar terms, right? And this gets to, the dollar. Yeah. And we'll talk about Japan too. In local currency terms, the MSCI Mexico index is up 19%. Not shabby. I mean, the S&P 500 is up 5% during this period, right? And so it was a 12% boost from 19 to 31 because of currency appreciation. The dollar going down, and then Mexican peso, and that's sort of counterintuitive. This is nothing to say. No opinion about the logo, things like that. You think about Trump coming in as president, America first, and like your expectation is not for the Mexican peso to appreciate 12%. But that gets to the fact that currency is a tailwind, right? And a lower dollar, higher international currency appreciation is a tailwind. The MSCI EFA index in local currency terms up 7%. US dollar terms, which is usually how all of us are invested here. Mm-hmm. MSCI EFA index is up 18% year to date. Wow. 18%. Japan, it's up less than 1% in local currency terms. Getting to Todd Son's point, maybe there's room there to run. But adjusting, in US dollar terms, it's up 10%. That's because the yen's appreciated. And there may be room for more appreciation for the yen. And that gets to, what Todd was probably talking about. Like Japan could run a little bit more here.
Mm-hmm. So now I'm going to throw you a curveball because you were talking about currencies. What about cryptocurrencies?
So
I know it's one of the most common questions that we get, and we're going to be very compliance friendly with how we talk about it. But you have any thoughts on the cryptocurrency front? How to invest? If you invest, do you want to invest at all?
So one thing is crypto is a speculative asset. That's why it's a speculative asset, right? And if you think about, and this gets to, okay, you can have views on crypto, but set that aside, because for us, three of us, what matters is, can we put it in the portfolio? Should we put it in the portfolio, right? And if we do decide to how do we put it into the portfolio? And with crypto, it's like, it doesn't have a long history. Now, you can do a back test, like a 15, 16 year or 17-year back test and say, oh, crypto's done amazing, right? So just based on a 17-year track record, let's do it because, the back tested returns look great. But then you can do the same with NVIDIA, right? Look at, put NVIDIA into the portfolio. You have, equally good returns. So why not do that, right? Like
that sounds fun. We should do that.
Again, not a recommendation or anything, but you see what I'm getting at. You can't just look at historical returns like, oh, the return's amazing. Like I can pick, like I said, I think any of us could probably make a good case for NVIDIA to do well. Dan Ives was on our podcast. He made a great case for NVIDIA. Yep. Like, why not NVIDIA instead of Bitcoin, right? But then you think about, okay, when you think about the portfolio, when you're adding something, last 2 years, you've been pedal to the metal, risk on. Mm-hmm. There was no room, in a sense, to add yet another speculative asset that, seemed very correlated with equities, right? And that gets to, if you're adding something, like, does it add diversification to the portfolio, right? Now, it's great when everything goes up at the same time, stocks, bonds, gold, all of it. But realistically, that doesn't happen. But so if you're adding Bitcoin, first of all, we need space in the portfolio, right? And then, is it providing some diversification, at least at the edge, right? And this year, actually, I've been pleasantly surprised that, especially April, May, when stocks were volatile, Bitcoin actually held up.
It did. That was one of the things we pointed out. I said, I'm really shocked Bitcoin's hanging in there as well as the relative. Yeah.
So I feel like when you look at crypto and Bitcoin, let's just say it's Bitcoin, right? Let's set aside the rest of crypto. It's too much to talk about there for all sorts of coins, right? Let's just talk about Bitcoin.
You don't want to talk about Fartcoin today, Sonu?
No, I don't think we want.
Not today.
Not today. Maybe on some live episode one day, when we're not recording. But no, look, with Bitcoin, it's the question, okay, how do you add it in the portfolio? Now, interestingly, if you go look at the historical volatility, it has to be based on risk. Okay, how much volatility, how much extra volatility does Bitcoin add to a portfolio? Barry, that's the stuff you look at day in, day out. Or anytime you're looking at adding something in a portfolio like gold, right? Gold is volatile, but it's got low correlation to everything else. And we've got, a very long track record for gold, 100 years, if not 2,000 years. And so, okay, you add it. Yes, it adds volatility, but not at the same time everything else is volatile. So there's diversification there. Question is what happens with Bitcoin. And then with Bitcoin, the thing is, because it's so volatile, you add it, and when we manage models, right, stocks go up, bonds go down, we rebalance. That's okay, right? Now, Bitcoin goes up a lot. Let's say stocks go down. When you rebalance, we have to think about what does that do with taxes? What does that do with trading and things like that? And you add, ironically, by the way, Bitcoin and NVIDIA have the same level of volatility over the last 3, 4, 5 years. It's about 55% volatility, right? And that's 3 times the amount of volatility that stocks have. Bitcoin is even more volatile over the last few years. It's become less volatile, but less volatile is only a relative thing here. It's 3 times as volatile as stocks. So we have to think about, okay, when you're managing a model like we do, for thousands, tens of thousands of clients, how much of trading is that going to create, right? Are they going to see on their statements of like, oh, these guys traded the portfolio today because Bitcoin went up and we had to rebalance? And then the next day Bitcoin comes down and then we have to rebalance again. It just gets very messy, right? And so lately what we've done is a concept called, I borrowed this phrase from our good friends at Newfound and Resolve Asset Management, return stacking, right? Can we get Bitcoin exposure without, taking stuff off the table, right? So what we've done is I won't mention any names of the fund, things like that. We just introduced Bitcoin into our alternative model, right? This is recently, I won't name the date or anything like that for various reasons. But we used a fund that gives us, if you put $1 into that fund, it gives us $1 of exposure to the S&P 500. So we get our equity exposure, but it also gives us 10 cents or 10% exposure to Bitcoin at the same time. So we don't have to worry about taking something out of the portfolio to get exposure to Bitcoin. Right, Barry? That's and that's how we think about a lot of diversification in our portfolios.
Yeah, and part of what happens with that within the ETF wrapper is that exposure gets held fairly steadily. And so that problem that you brought up of constantly having to think about rebalancing isn't there. If you have extremely volatile assets that regular rebalancing is important both from a risk and a return perspective. If you're managing a multi-asset model where a lot of people are invested in it, you just can't do that. You can't do that very easily. Mm-hmm. And so we're looking for means. I think smart asset managers are always looking to create tools that actually help advisors do the right thing. Sometimes they create tools that help advisors do the wrong thing, but that's often only incidental. It's not what they're trying to do. And we're always looking for good ideas that we think do the right thing, do the appropriate thing for getting the right type of exposure in a portfolio efficient way.
And that's Barry, that we use that same concept, return stacking, to put managed futures into the portfolio too, right? Because usually the problem is, I want to put managed futures, but I have to sacrifice equities, or I have to sacrifice bonds, or both, right? So Barry, talk about how we've used that same concept to layer in an additional diversifier into the portfolio.
Yeah, same idea. We can use that return stacking phrase again, where you can get your full equity exposure, and then you add to that some kind of diversifier. Now, you don't want to leverage up. I'm not a fan of 2 times whatever products. Right? You don't want to add leverage because that's simply adding risk. You use something like return stacking, the idea of return stacking, to keep your primary exposure and then to add something that can actually help to mitigate overall risk. And we have strategies that do that with managed futures. We even have strategies that do that with fixed income as well, where you're not giving up your equity exposure, but you're getting exposure on top of that to the diversifier as well.
So if you want to hear the latest from us, don't forget to subscribe to our podcast. You can also leave a review. We love your feedback. This is episode 142 of Facts versus Feelings, talking with the best portfolio manager we know. And after 39 minutes, I think you probably agree with why we titled this the way we titled it. The problem is we're getting near the end, and we could do this all day, and we do. This is honestly what we do all day. So Barry, in a past life, you worked at a big institutional research shop. I've worked at big institutional research shops. We know the flaws with them. You can't get anything done because it's too big, it's too corporate-y, it's too this, it's too that. Talk to any financial advisors out there that are listening to this podcast saying, wow, these guys actually do manage money. They have an incredibly thoughtful team behind the stuff they do in this podcast. Why should someone join up with Carson? What are some differences between Carson that you've seen the, I guess it's almost 2 years, right? Yeah, 2 years you've been, because I've been here 3, so I was 1 year before you. The almost 2 years you've been here, how are we different?
Yeah, it's when I worked at a big institutional shop, one of the things that you find is that there are a lot of different siloed people who cover different things. You've got your due diligence people and your fixed income person and your equity person. And what happens is if you generate a view, then all of them want to generate that view. So if you're in a risk on environment, the fixed income people want to choose risk on fixed income. The equity people want to choose risk on equity. The due diligence people want to choose risk on due diligence. And then all of a sudden you get way out over your skis because everybody wants a piece of that. And I think one of the things that we can do, because we can all work together very effectively, is to think about portfolio from the big picture perspective. I think there's always one of the most important things in markets is that markets are forward-looking. You need to be forward-looking too. You need to be thinking about what is priced in, what's going to happen, not what has happened. It's very easy to predict history because it's already happened. You're always looking ahead. And I think it's a lot harder to do that in an institutional shop. I'll give you one example. I was at an institutional shop and they wanted to create new bumpers for the portfolio, new rules for the portfolio. And bonds had just done great because we just went through the beginning of COVID and yields had absolutely collapsed and, we weren't overweight duration when it did. So they made a rule. They made a rule when, the 10-year yield was at whatever, half a percent. They made a brand new rule that you could not be more than 1 year underweight duration. Right? If the ag was at maybe 6.5 at the time, you couldn't go any lower than 5.5. Hard and fast rule, because they weren't thinking about looking forward anymore. And it's obvious. I mean, now it's obvious in hindsight, but even anyone with just a little bit of foresight would know that when yields are that low, that's not when you want to be making that kind of rule. But that is exactly the kind of mistake that institutional investors can potentially make. I mean, there are a lot of great institutional investors out there. I don't want to say that the word institutional is bad. They're brilliant people. They do great things, but there is this risk of the tendency to be reactive in what they're doing and to be siloed in what they're doing. And I'm just really grateful to be part of a team where we don't feel like we have to be reactive. We don't feel like we have to be siloed. We can work with advisors and really try to do the right thing by them and do the right thing by their clients, know who they are, know who they're working with, and get to good results.
So, Sonu, I'll jump in. You can jump in a second. I'm amen to that. Joe Granville, another good quote. If it's obvious, it's obviously wrong. I think that decision that was made, obviously wrong. I remember when you started with us and you started really peeling back the onion and looking at the money and the models, and when you realized how short we were duration, you had a big smile on your face for about 3 weeks because you realized, oh, we can actually do what we need to do, not what we're told to do by somebody sitting up in some glass house who thinks they know what they're talking about when they're not out there talking to advisors, not out there doing the due diligence we do, living the real world things that we do, creating a big macro view, but also making sure those models do what they're supposed to do to help our Carson partners and help their clients. Probably, I don't know, one more from you, Sonu, one more from me, and we probably need to wrap this thing up here, episode 142. This has been awesome, by the way, Barry. And literally, when I say we didn't have a script, I'm talking, we just are talking. We literally have no script today. We're just doing what we do every single day. This is pretty easy, actually.
We weren't too worried about it. Barry, you kind of touched on this, but maybe I think it's a good place to end. A lot of people, when they manage portfolios, even they, it can be institutions, sophisticated portfolio managers, advisors, clients at any level, right? I feel like a big thing, you and I have talked about this a lot, is the focus is on individual line items in the portfolio. It's like, oh, I have this fantastic product. I have this fantastic fund. Let's go buy it, right? Without thinking about, and this gets back to what we were talking about Bitcoin too, right? How does it actually interact with the whole portfolio, with everything else that you have? Does it add risk? Does it take away risk? And because returns is actually, we can't predict returns. Right? I'm not saying we can predict risk by itself, but it's quote unquote slightly easier, right? Correlations, if you have some estimate of it, you can do that. So talk about that with respect. Maybe that's a good place to finish up along with Ryan's question about thinking about the entire portfolio as opposed to individual line items.
Yeah, I think that's key because how those line items interact, that's what determines what you get from the portfolio. So we're always looking at that. We're literally looking at that every day. Every day I send a note out to the team, a short note, just what happened in the markets today. How did the portfolios behave? What were the drivers of that behavior? And did things happen the way that we expected to? And a lot of times in those notes, I write, we lost some ground with this particular feature, but we more than made up the ground with this particular feature. And that's the whole point. If you have a portfolio where everything is working at the same time, you probably don't have a good portfolio.
That always scares me because we know what's going to happen.
Get yourself into trouble. So you're always trying to. I mean, you want the pieces to work together in a way that helps you outperform, but you don't want them to be all doing the same thing at the same time. And that's part of what we have a lot of fun doing.
We also have a lot of fun because July 4th is this week, right? By the time people listen to this, it's maybe already happened. Barry, you have any big July 4th plans in Massachusetts? What are you doing?
I am trying to keep my dog from being terrified.
Okay.
Oh yeah,
if you're a dog, I love July 4th. I actually, it's corny, but I read the Declaration of Independence every year on July 4th. But my dog is terrified of fireworks and little firecrackers that people set off. So July 4th is about keeping my dog from having a nervous breakdown.
And speaking of Barry, it was great to see you. I'm actually 4 or 5 blocks away from Barry right now. I'm in Boston. Barry, you're in Boston too. So
that was a lot of fun.
Yeah.
You know what? How was dinner last night? I heard Barry was cooking some food for Sonu. How was it? I haven't talked to you guys yet.
I did. I take no credit for doing the cooking. I have a amazing partner and wife. And
Jenny
she loves
was
to cook,
amazing.
and I'm very lucky that she likes to cook so much.
We had a great time, food and drinks, and I must say that what took the cake literally was Jenny's strawberry shortcake. It was phenomenal. I was so tempted to go back for seconds and thirds, but obviously I'm in no position to do that. But I'm still like, I'll have that memory, Barry. As nice as the conversation was too, the shortcake took the cake.
I think
It is a favorite.
We've made jokes about this. Sonu's not a fan of salads. Anything green, he's not. One time I got a salad and he said, I'll take what you had. I ordered him a salad and he was just picking at it. He didn't know what to do with it. He just picked at it for a while, didn't even eat it. I joked with Barry when Sonu got to your house. He should say, we're having a bunch of salad today. You didn't do that, did you, Barry? Did you not do that to him?
I avoided the salad. We did serve a vegetable, but we avoided the salad.
Okay, I said, you want to mess with him? Tell him we're just having green stuff all night. His face will start. He won't be too happy. Anyway, all right. Well, listen, everybody. Thank you, Barry. That was awesome. Thanks, Sonu, as always. Thank you to all of you who've been here all year. We've been doing these every single week. This is episode 142, but we've reached the midpoint of 2025. It's been really interesting, but the good thing about it is we're going to keep doing these. We love doing these podcasts. We're going to keep having amazing guests like Barry, and I hope a lot of financial advisors out there that are listening are realizing that Carson Investor Research isn't just two guys that talk on a podcast. It is a 15, 16 person team with some of the most thoughtful, very best people in the entire industry that are helping really move this industry forward, helping our Carson partners grow, and more specifically, end of the day, helping their clients feel good about how things are going. And if you're an advisor and you're interested, you should be by now, I hope, carsongroup.com, or just reach out to us. We would love to talk a little bit more about all the different things Carson's doing to really change this industry and help people grow. So with all that, we'll be back next week with our mid-year outlook. We'll see everyone then. Thank you. Take care.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.